Good day and welcome everyone. We welcome you to Alpha Planning's ongoing investor coaching series to help people achieve financial peace of mind. And just to give you a little quick background on myself, I'm the founder of Alpha Planning. I'm your instructor today, and I do hold an MBA from Baldwin Wallace University. Used to be Baldwin Wallace College, now it is university. And I am a certified financial planner, or CFP. And I've written a second book called The Skinny on How to Have a Fat Retirement, which is available at Amazon. And I've been quoted in multiple journals, as well as my TV interview this year, actually, in 2013, has been shown on the major networks that you see below. So just to give you a little idea of my background, but let's get right to the education. Separating myths from truth, the story of investing. We're going to dispel investing myths, common ones that we all have done and some are still doing. I'm going to explain the academic story of investing, so you can get it really a very clear story of how we got here, and then opportunity to achieve some investing peace of mind, true investing peace of mind at the end with the 20 must-answer questions. So what is a myth? A myth, story made up to explain a phenomenon beyond the science of the day. So here are some common investing myths. Okay, we believe that investors have simply taken some concepts for granted as being good investment advice. But when you talk about investments with a stockbroker or a traditional financial advisor, typically commission-based, it's common to ask questions such like these. You have probably asked these very questions yourselves. First, what stock or investments do you like? This question potentially reflects what we see as the first myth. Stock selection can consistently provide good results. Second question, who is your favorite manager? And this lends itself and reflects what we believe is the second myth. Investing based on a manager's track record can consistently provide good results. Thirdly, where do you think the market is going? I would like a quarter for every time someone's asked me that one. This question speaks to what we see as the third myth, which is in market timing. And the myth is that if you believe market timing can accurately predict when to get in and when to get out of the market at any given time. And finally, the fourth myth is that, one nobody really likes to talk about much, but I'm a big hawk on it myself, and it's thoroughly addressed in my book and others. But the cost of investing. There are 44% of mutual fund costs are legitimately hidden from investors. So let's take a little bit of time on each myth. So we're going to look at stock selection. Our first myth, this is the myth investment advisors can consistently predict and predictably add value through individual stock selection. So they're saying the market is inefficient and then they could find things that are just not being priced in, and they could take advantage of those things one way or another. So relying on stock selection as an investment approach is a belief that someone can pick stocks that will do well in the future, beat other stocks, or beat the market in general. The myth about stock selection is that an investment advisor exists who can consistently and predictably add value to your portfolio through individual stock selection. You have to ask, if this person knows these things in advance, I don't know if they would be sitting with you or me talking about investing with them. They wouldn't need to. Here's a survey question for you. Have you ever owned a fund that got closed or merged into another one? What happens to the performance return data for a fund that gets killed off? Do you know that? Well, the answer is it disappears. So, if you could look at all the data for live funds and dead funds, what do you think happens to the average fund performance statistics when funds die? Matson Money decided to research the answer to that question, and to find the answers, they brought in a $25,000 mutual fund database developed by the Center for Research and Securities Prices, more commonly known as the CRSP. which is part of the University of Chicago's Booth School of Business. The CRSP, as you'll see in some of our index examples, survivor bias funds, and serves as a foundation for research and benchmarking mutual fund performance. So Manson Money uses the database to look at the CRSP mutual fund data over the past several years. And in working through the data, here are Manson Money's current findings. What you're looking at here is the data of the whole entire history of mutual funds from the very first year, 1923, where the very first mutual fund was born. You'll see in this chart that we're looking at the number of funds, the number of new funds created, and then the number of dead funds over the last 90 years. First, the data demonstrates that in just 1 year, 2012 for example, that there were 29,152 open mutual funds. That's over 3 times as many funds as there are publicly traded stocks in the U.S. Think about it. There are more funds with baskets of stocks than actually publicly traded stocks in the U.S. market. Okay, so what happened behind the scenes on these? And it's a very compelling story. Going back in this data from 1923, a total of 51,905 funds have been born. If there are currently only 29,000 funds open, how many of the nearly 52,000 were scrapped? And that number is over 22,000. So what happened to the funds that didn't make it? Why do you suppose they disappeared? It begs the question. An even more interesting question is what happened to the performance return data for the funds that were scrapped? Well, they hide it, but the returns, this data includes the performance track record of closed funds, and it just simply disappears when they kill the fund. For example, take a look at the average cumulative return of the 200 worst performing mutual funds ever closed. That's a resounding negative 79.3%. Yet, once closed, this negative cumulative performance data just disappears like it never existed, never to be referred to again. How many ads have you seen on CNN for mutual funds that lost 40% of their value? When was the last time you saw that? My guess is that there's probably not many. That's because funds that underperform, that are significantly, are generally closed or merged into more successful funds. So it's really a big shell game. So let's look what happens to average returns when all data, good and bad, is included. We're going to look here and see how much money is lost to active management. When Manson Money compared the average performance data of all the U.S. equity mutual funds, and this is including data for closed and merged funds, comparing them to the S&P 500 market index for large caps and to the CRSP market index, which I've explained earlier, for all publicly traded equity securities other than ADRs, which are American Depository Receipts. The result is the information reflected in this graph. The markets significantly outperformed actively managed mutual funds over the long term. So the average potential wealth loss to active stock management in the study was almost $2 million. Now, the last slide compared the average of all equity mutual funds in the survivor bias-free mutual fund database with the S&P 500, an index of just large U.S. stocks, and the CRSP market index, an index of all publicly traded equity stocks other than the American Depository Receipts. Now let's look at what happens when we compare the average of all U.S. mutual fund data to 4 sample asset classes. Okay, which are asset class mixed categories we created using back-tested historical market data. Now, the 4 hypothetical market portfolios labeled respectively conservative, moderate, growth, and aggressive range from 25% equity, which is a conservative portfolio, all the way to 95% equity, which is definitely an aggressive portfolio. and that tend to have complementary risk-return characteristics and dissimilar price movement. So the conservative model is 75% fixed income and only 25% equities. The moderate portfolio is a 50-50 mix, meaning halves in equities, halves in fixed income. The growth mix is 75-25, or 75% equities and 25% fixed income. Finally, the aggressive is really aggressive, reflecting 95% of equities and only 5% fixed income. These hypothetical portfolios do not reflect any of the actual trading by Matson Money or any actual portfolios managed by Matson Money. These are historical theoretical returns of asset class mixes over time. The performance of each asset class was created, like I said, using historical back-tested market performance derived from relevant market indices that, as discussed in all the endnotes that we have. So, Matson Money allocating across each category to reflect the same types of portfolios as those represented by the hypothetical portfolios. Now, you may be thinking, this is just an average of all funds. I'm not going to use an average fund manager. I'm going to find a better than average fund manager. So how would you identify the mutual funds that would end up being in the top half of the average rather than the bottom half? How could you find them? Let's look at history or track record, which brings us to myth number 2, track record investing. The myth is finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. Your suggestions raise what we view as the second myth, which is track record investing, using performance history to determine the best investments for future performance. The myth is that by finding funds or managers that did well in the past, reliably determine which funds will do well in the future. So let's see if picking the best performers is a reliable method for finding the best investment advice. If we were to search, this is the top 30 funds guessing game, okay? And if we search for the best managers, we should use a short track record or a long track record. I would say long. Then the 10-year history would be helpful, right? But let's start by looking at a 10-year period from 1993 to 2002. This is a list of the top 30 mutual funds during that period, compared to all funds, the S&P, and the U.S. equity market as a whole, and that's the CRSP that you see there. Here's a little known fact, that mutual fund companies would probably rather not discuss that 10-year period. Out of the entire CRSP universe of 1,800 plus U.S. equity mutual funds that were open in 1993, only 725 had a track record even at the end of a 10-year period. So what happened to them? They were killed or they were merged. Okay. So let's see what these top funds did in the following 10-year period. Did they repeat the performance? No, actually they underperformed the S&P index and the market as a whole by significant margins. What's worse, once you realize you weren't doing as well as expected, there were even more funds out there to choose from in your search for an alternative. And here again, we see the same curious phenomenon in the survivorship of mutual funds. Only 3,700 funds with 10 years of history managed to even stay open from the beginning of 2003 to the end of 2012. As we saw earlier, even after killing off some 22,000 funds, there were still over 29,000 funds still in existence in 2012. So how many do you suppose will still be alive 10 years from now? And how in the world can we identify the best ones in advance? Oh, and remember what happens to the performance history of the funds that die. It goes away. So here's another problem with our search for top performing funds that die. Most folks don't hold their mutual funds for 10 years. In fact, the average holding period, which was from a quantitative analysis of investor behavior by Dalbar, the average holding period is 3 years. That is not long term. So let's see what this means by our search for the top performers based on just a 5-year time period. Here's the similar study using 5-year time windows, and what we find is a similar result. Take a look at 03 to 07. The top 30 fund average return was an extraordinary number, over 10 times what the average U.S. equity fund return for that period. Now that these amazing fund managers have been identified, they're on the radar, and they're on their extraordinary 5-year run, look what happens from 2008 to 2012. Was past performance repeated? Did they once again dramatically beat the market? No, they did not. In fact, they only slightly overperformed the S&P while losing to just the general market as a whole, as represented by once again the CRSP index, and finished well below small stocks for that same period, as represented by the CRSP 9 to 10 index, an index which is of the smallest cap stocks in the market. Meanwhile, we had even more mutual funds to choose from as replacements. Here's the point. A manager's ability to pick stocks in the past has, I will say, zero correlation with his or her ability to do so consistently in the future. So we'll go to myth number 3, which is market timing. Market timing is an attempt to alter or change the mix of assets in a portfolio based on a prediction or forecast about the future. The myth, bottom line, is that the mutual fund managers are able to utilize market timing to effectively predict up and down markets. So how easy is it to get in and out of the market at the right time? Dalbar, once again, is an independent research firm that, among other things, has done major studies on investor behavior. The QAIB, the Qualitative Analysis of Investor Behavior. As I discussed a moment ago, Dalbar looks at the real results investors get. So in 2011, Dalbar concluded a 20-year study of tens of thousands of brokerage accounts for investors with over $100,000 invested. So a pretty representative group of investors. And here's what they found. During the 20-year time period, the S&P returned how much? 7.81. What was the average equity investors' return during that same period? 3.49. But where the rubber really meets the road here is find investors' real returns in terms of purchasing power regarding inflation. What do we have to do with inflation numbers? Subtract it. So net of inflation, then how do we do? You can look at it and you can do the math yourself. So the point is, market timing is basically just a very risky proposition. I mean, missing the market's top performing days can prove costly. This chart shows how a $10,000 investment would have been affected by missing the market's top performing days over the 20-year period from January 1, 1993 to December 31st, 2012. Now, for example, an individual who remained invested for the entire time period would have accumulated over $44,000 over the period, while an investor who just missed the top 10 performing days during that period would have accumulated literally half of that, nearly half as much. So now, realizing that we had a total of 5,040 trading days in the period that we're looking at here, if you only missed the 10 best days, you got less than what you could have earned in T-bills. It isn't difficult to see what market timing is, and it's a very risky proposition. When it comes to your long-term wealth, being out of the market can be very expensive. Transition, right here we're looking at the frightening part is that market timing can be disguised, and investors often don't recognize it. And sometimes it goes under the auspice of tactical asset allocation. Tactical asset allocation can really just basically be market timing in disguise. Many professionals will tell you they don't believe in market timing, but instead they will create for you a diversified portfolio with international stocks, U.S. stocks and bonds, and small cap stocks using tactical asset allocation to change the mix on information about which markets are underpriced. So you would think the market is inefficient and that somehow you can outsmart it. And however, if the manager is changing the mix of assets based on a prediction or forecast about the future rather than on portfolio diversification principles, designed to reduce the unnecessary risk, this should be a red flag because it's just another form of market timing. Many people think of market timing as involving just two assets. For example, getting 100% out of cash, 100% into stock, or vice versa. Tactical asset allocation uses between 6 to 15 asset categories and trying to allocate or pick and choose between them and change the mix based upon the most current market forecast, which doesn't make it any easier, it just makes it harder. So don't be fooled. Tactical asset allocation is just another form of market timing. Market timing has been analyzed by the best and the brightest academic minds. For example, 1985, Charles Ellis, the founder and former managing partner of Greenwich Associates, a leading financial services consulting firm, authored Investment Policy, How to Win the Loser's Game, which was updated in 1993. Now, this is considered must-reading for serious investment advisors, and his book states, the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. So we've seen that the traditional investment strategies involving stock selection, track record investing, market timing are not consistently effective methods of investing. They aren't predictable, they aren't repeatable, and they can be forms of speculation and gambling. And there's still one more issue we need to get out into the open, is cost. The cost of investing are really the totality of any fees or charges incurred by investors to buy, sell, and own stocks or mutual funds. We believe that the myth associated with investment costs is what you don't see can't hurt you. I explain this to people that just because you don't receive a bill for an expense, because it's basically just anything that takes your wealth away is an expense. If you had to write a check for all the hidden fees and all of your mutual fund and investment costs every single year, you would then be more cognizant of what you're paying and want to lessen it if there is improved alternatives out there, which of course there are. So that's the myth, what you see can't hurt you. So what are some of the important costs that we may not see in our investment portfolios? Well, first let's talk about the bid-ask spread. What is that? And we'll also talk about the expenses in mutual funds. Okay. The bid-ask spread is directly connected to buying and selling securities. If I get on the phone and call a major wirehouse right now and say I want to buy 100 shares of any large company stock, the person on the other end might say, you can buy a stock for $50 a share and my commission is $25. If I immediately realize I wanted to sell stock rather than buy and turn around and say, wait a minute, I don't want to buy, I'm sorry, I want to sell 100 shares. I'm not going to be able to sell for the same $50 that I was just quoted. I might be able to sell at $49.50. Now, where does the difference between what I can buy for and what I can sell for go? That's what's called the spread. That is why online companies and market makers and brokerage houses have no vested interest per se in your gains or losses. They just want to encourage lots and lots of trading because they make money no matter what. It's common sense. So you might think that I could sell my shares of stock directly to you, but that isn't how it works. I know you've seen movies or commercials showing folks running around the floor of a stock exchange with those little tickets. But those guys are called market makers or specialists. And my shares are really sold to one of those guys who gets a fee for buying the shares for me and finding another investor to buy them. There's always someone on the end of every transaction. So every time a stock changes hands, the exchange takes a fee for facilitating the trade, the spread. Whether you're an individual investor or a big mutual fund, if you're buying and selling securities, you're paying the bid-ask spread. Just because they buy in bulk mutual fund and investment companies, they do not get any kinds of breaks. In fact, it is more costly as it increases for you, for the investment holder. So let's find out what these costs can really do to you. In large stocks, such as those included in the S&P 500 index, especially Fortune 500 companies, stock trading commissions run about 6 basis points. So if we want to do what is known as round trip selling out of one stock and buying another, then that's 6 basis points to sell, 6 basis points to buy, plus approximately 0.5% in bid-ask spread. That is about 0.62%. So buying and selling shares of medium-sized companies, also known as mid-caps, okay, these can run even higher to 12 basis points. So a round trip on that is going to be 12 and 12, and that's 24% plus the 0.5% spread, which comes to 0.74, almost 0.75%. If you have ever seen a TV commercial or heard a radio ad that says you won't be charged any commissions, you may wonder, how can they do that? Usually those offers are exclusively for very, very small companies where the bid-ask spread can be as high as 1.77%. Clearly, they are still getting paid. So size makes a difference in cost. 1.77 to sell, plus double that to buy. And it's, gosh, well, thank you for not charging me a commission. It's so important to understand how that works, that the bid-ask spread is a major source of Wall Street revenue that is often unseen and usually unknown by the typical investor. So bid-ask spread is an expensive and unseen cost of investing that takes away value from the portfolio every time it happens. So high turnover, bad. Low turnover, good. Well, let's look at how this cost affects consumer just no-load funds when they think they have no expenses. Many people say, I have a no-load fund and I don't have any expenses. That's completely untrue. There's no fund in the world that doesn't have expenses and trading costs. So as the great Charles Ellis, who was the author of the investment policy Winning the Loser's Game in 1993, the key question under the new rules of the game is this: how much better must the active manager be to at least recover the costs of active management? He says the answer is daunting. So far, up to this point, we've debunked 4 common investment myths. The first 3, which relate to stock selection, track record investing, market timing. We've shown that they do not work consistently or predictably. We have also demonstrated that what we can and what we can't see can hurt us, because there are costs of investing that can siphon returns from our investment portfolio without our knowledge or awareness. So I'm going to tell you the exciting, refreshing Mattson story about investing. We're going to show you the academic approach. The story of investing, Mattson's free market portfolio theory. Mattson's free market portfolio theory is otherwise known as FMPT, is an investment approach based on accepted financial theories and academic research from the last 50 years. These concepts form a solid, disciplined, and diversified investment strategy which seeks to rationalize investment behavior. Mattson's free market portfolio theory is based on 3 academic principles, and they are: free markets work, modern portfolio theory, and the 3-factor model. And if this sounds complicated to you, please don't be scared off, because we're going to break down and simplify each one of these for you. But before we do that, let's meet some of the people who pioneered these principles. Over the past 50 years, there's been much research in the field of economics, and specifically in the field of investments, and this research is conducted through some of the leading universities in the country, including Yale, Stanford, and most notably the University of Chicago, which has been the home of more Nobel Prize winners in the field of economics and their research than any other institution. Notable researchers in the investment field are Harry Markowitz, William Sharpe, Merton Miller. In 1990, these U.S. economists shared the Nobel Prize for their pioneering work in the theory of financial economics. And their concepts help to define what we call as modern portfolio theory, and we'll discuss a little bit more about that a little bit later. Nobel Prize winners, authors, and leading academics created these principles on which the Manson approach is based, which is what alpha planning, we use this. So Rex Sinquefield and Roger Ibbotson were co-authors of Stocks, Bonds, Bills, and Inflation. Their pioneering work forms the basis for avoiding some of the traps of traditional investment methods. Next we have Eugene Fama, the father of the efficient market theory. And we'll explain what that is. And the three-factor model. Kenneth French, he was the co-founder with Eugene Fama of the three-factor model. Their pioneering work forms the basis for avoiding some of the traps of traditional investment methods. So now let's examine what these distinguished people have to teach us as we learn more about these three principles to help us understand free market portfolio theory. Okay, the point is that free markets work. Free markets do work, and it was first developed by Eugene Fama in 1965 in his doctoral dissertation. Fama said, in an efficient market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. So to understand this theory better, we need to consider two different ways of looking at the market. One, that markets are efficient, and the other, that believe markets are inefficient. So there's another side of the story. To help us understand free markets, let's first explore the notion that markets are inefficient. Let's say that we think that, meaning that markets consistently misprice goods and services, and if that's true, it would be possible to take advantage of mispricings or arbitrage and pass value onto the investor by increasing returns and avoiding losses in investments. So people who believe the market is inefficient would utilize the three traditional investment strategies we just talked about: stock picking, market timing, track record investing. Now let's see what the idea that markets are efficient can teach us. Here's the alternate belief. Get these up here for you first. Okay. The other way to view the market is based on the hypothesis that markets are efficient. What does that mean? That the free market is the best determinant of market prices based on supply and demand. All available information is factored into the current price. Only new and unknowable information and events can change pricing into the future. The randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. The technical term for that is alpha. This view explains why active managers aren't able to consistently and predictably beat the market. The efficient market hypothesis says that nobody can. It would appear to be consistent with the information we reviewed earlier about stock picking, market timing, and track record investing. So there are people in both camps. Some think the market is efficient, and others that think it's inefficient. If at this point you still feel that it is inefficient, then you may want to stop this tutorial right now, because unless you just are still open to ideas, I would still continue on, of course, but most of us have never really thought about that until we bring it up to them. So however, as an investor, it's tremendously important for you to define your belief structure. Most investors have never had this opportunity. So they simply use the latest hot investment strategy or one recommended by a friend or neighbor or colleague, someone they used to work for. But I know that once you're able to define what you believe, you will know how you want to manage your money. Because the point is that our beliefs dictate our actions. Okay? So there are two completely different ways of looking at the world. And in the age of many shades of gray, please excuse the pun, this decision is black and white, really. You can't be part of both. Attempting to believe a little bit of both and taking actions based on contradictions will really just absolutely prove disastrous for you. So that would never work. You simply can't have it both ways. Because if you think that markets are inefficient, then you must continue trying to take advantage of these inefficiencies through stock selection and market timing. But if you believe markets are efficient, then you should be looking for a different investing path. So market efficiency is the first principle on which Matson's free market portfolio theory is based. So let's look at what the academics discovered as far as a better way to invest for those who believe that the market is efficient. Look at modern portfolio, the second principle on which Matson's free market portfolio theory is based. Modern portfolio theory, and then it works. Diversification works. This was developed using the concepts of Harry Markowitz, Sharpe, and Miller. And modern portfolio theory examines portfolio performance based on risk and return. And this theory won these three men a Nobel Prize. Okay, I would like to introduce Harry Markowitz. In 1952, Dr. Markowitz, he was the pioneer of modern portfolio, wrote his doctoral thesis. His thesis formed the basis for a Nobel Prize he shared with Sharpe and Merton in 1990, based upon their work in the field of financial investing. It took nearly 40 years for computer technology to advance to the point where his theories could be proven. That's really pretty incredible. Much like Albert Einstein, who wrote the black hole theory on the back of an envelope, even though the first black hole was not actually discovered in space until 40 years later by the Hubble telescope, Mr. Markowitz, like Einstein, was truly ahead of his time. He's the one who figured out how to use the efficient frontier to look at risk and returns. This graph here is the efficient frontier. This graph represents the Markowitz efficient frontier by plotting historical market data, in this case from 1993 to 2012. It's a hypothetical illustration of optimal portfolio return for any given level of risk. Now consider, for example, an investor who's 100% invested in S&P 500 stocks with a historical rate of return around 10% and a historical volatility of 19. You see the red where it's plotted on the slide? Okay. If you're comfortable with that level of return, then why can't we move you straight across this graph to pick up essentially the same return with 1/2 of the volatility or risk? The x-axis is volatility, the y-axis is your compounded return numbers. And every one of your current portfolios can be plotted and to see where they fall on this frontier. I can tell you 99% of anybody I've ever met in over 2 decades has never even been close to the efficient frontier, and it can be accomplished. So using what we call the Matson MRI report, we can plot where your current investment portfolio falls on this efficient frontier, and we'll be examining ways in which hypothetical portfolios can be moved from higher to lower volatility without, and listen carefully, without sacrificing opportunities for return. It is a myth that you have to take a lot of risk for improved performance. In fact, we'll show you quite the opposite. So how do we create an optimal portfolio given that we don't want to employ traditional investment strategies or the 4 myths that we've been discussing, for example? Okay, asset allocation based on diversification rather than market predictions or stock picking, individual stock picking, is a way to pursue the opportunity for successful free market investing and efficient investing. So to do that, let's look at this graph here that you see in this pie chart. And this is published by Brinson, Hood, and Biebauer in the Financial Analyst Journal. And what they have determined is that 91.5% of any portfolio's return is determined by how those assets are allocated amongst asset classes. In simpler terms, what the mix of asset classes do you pick? And it also demonstrates again that market timing and stock selection do not add value to investment portfolio returns. This means you don't need to worry about which individual stocks you own. You don't have to keep. You have to have a breakthrough from the old traditional. Really, they're wrong to ask people if they know if a stock's going to go up or if the market's going to go up. Where do they think things are going from here? This eliminates all of that. Really just speculation and just talk. It's not anything constructive or actionable in any consistent way. So we're going to look at the concept, though, of correlation, okay, between asset classes. The point is that correlation is the cornerstone of diversification and may help you potentially achieve higher returns with less volatility. So what is correlation? Correlation is the relationship between two investments. Let's take a look at how similarly or dissimilarly various investments behave in the market. Utilizing investments with low correlations is one of the best ways to reduce the risk in your portfolio. Finish this statement for me. If you want to pursue extra return in your portfolio, you have to take more what? Risk. Right? As I said a moment ago, no, wrong answer. Harry Markowitz's research proved that different assets can be combined in a portfolio that will offset each other's risk because of their correlation relationship. What we're looking for are assets with dissimilar price movements. You don't want all of the positions in your portfolio to go up or down at the same time. So that when one goes down, the other has a good potential of offsetting it with an up period. Okay, so Dr. Markowitz measured the likelihood of various asset categories moving dissimilarly, and it is possible to have two assets that look fairly volatile individually, but when combined in a single portfolio can reduce volatility and increase the potential rate of return. So once again, to restate, correlation is the cornerstone of diversification. So let's look at building a portfolio using the benefits, the cornerstone, the benefits of correlation. Let's consider how to lower volatility without sacrificing our opportunity for returns. The lower the correlation between two asset categories, the less similar they are. So we look at the S&P 500 from 71 to 2011, assuming hypothetically that one would have invested 100% in the portfolio for this example during that period. It would have had an average gross return, meaning before costs, any cost could be deducted because indices do not have costs, of about 9.94%, and a volatility swing of 17%. So let's backtrack for a moment to explain some terms, because you have to know this if you're not familiar with it. And like I said, please feel free to go back to certain sections or to this whole thing as often as you need to. Well, you should always consider risk in the investment process. You've heard someone say that. But they haven't shown you how to measure it. And it's really pretty unusual to be shown how to compare risk in one investment to an alternative. So it is just referred to in conceptual terms, but nothing that really is constructive. So academics measure risk mathematically, and it's called standard deviation. That was our x-axis on the Markowitz frontier a couple of slides ago. And all you have to do, remember, you don't need to know how it's calculated unless you want to, but all you have to remember for now is that standard deviation is really a form of volatility. The higher that number is, the higher the volatility, the bumpier the ride. So let's begin diversifying our S&P portfolio, and we add the green block, okay, with 30% in large cap international stocks, This creates the opportunity to increase return while at the same time reducing volatility. The higher the number is, the higher the volatility. Remember that. So this very simple hypothetical demonstrated the potential to add almost 1% in return without increasing volatility for that same period. In fact, it actually decreased it slightly. So the efficient market hypothesis tells us that prices are rational, and modern portfolio theory shows us how to use correlation to create an investment portfolio with less risk without reducing the opportunity for return. Let's check out the third principle upon which Mattson's free market portfolio theory is based. And this is called the three-factor model. And this was created by Eugene Fama and Kenneth French. Just FYI, Eugene Fama just won the Nobel Prize in 2013, just a few months ago, in economics, of course. Congratulations to him. So the three-factor model identifies three sources of risk that the market rewards. Okay, so the factors are the following. Market factor, we'll explain what all these are. Market factor, size factor, and value factor. So this model takes the relationship between risk and return even further than just modern portfolio theory, because it makes possible to calculate expected returns based on these risk factors. So the three-factor model explains 97% of the variability of returns. That's an incredible, let me say that one more time. The three-factor model explains 97% of the variability of returns. So let's examine each risk carefully. Okay, factor one, the market factor. I'm going to put all the points up here first. Okay. The market factor tells us that it is inherently riskier to invest in the stock market than it is to invest in fixed income, which are bonds. Because more risk is involved, stocks have the potential to provide a higher rate of return than fixed income instruments, and I doubt many of you would really even disagree with that. So over long periods of time, the market has historically rewarded equity investing. In fact, as Mark Manson says, and I agree, that equities are the greatest wealth building tool ever known to mankind. And what else has the market rewarded us for? The size factor. The size factor takes into consideration the size of a market cap, the market cap of a company in which you're investing. So when investing in the stock market, small companies have the potential for higher returns than large companies, due to the fact that small companies are generally riskier than large companies, and obviously they have the greater ability or potential of having exponential growth because they're small to begin with. So the market historically has rewarded you for investing in equities, especially for investing in small companies. Now let's look at the third factor. I'm going to give you those returns here first. Okay. Okay. And we will look at the third factor. Okay, the third, value factor, refers to the extra risk exposure and the extra risk premium of investing in high book to market, or what one would call value stocks. High book to market value stocks simply means companies that have a lower market price than other companies relative to their size. That's pretty much it. These types of companies are usually experiencing some kind of financial distress, and usually their earnings are currently down. And as a result, they are riskier, but they offer investors the potential for a much higher return. So in summary, the three-factor model tells us that the market is expected to reward investors for taking risks, especially in equities, a bit more for small companies, and even a bit more for distressed companies. But you should not forget that investing in the stock market does always involve risk, and your investments may even temporarily lose money. Give you the numbers on this one. Give you a chance to look at them. So in summary, the academic approach believes that the free market portfolio theory is really, it's based on free market, the fact that free markets work, modern portfolio theory, and then the three-factor model. And this eliminates the need for all of those cliched mindsets that we had, and I had these too. This whole process changed my life and gave me financial peace of mind myself, and I'm sharing it with anybody who will listen. So, you don't need to rely on those traditional myths of investing, and that academic is a better approach. It is prudent investing. It's the mere definition of it. So building a better portfolio, average investor equity performance. Let's look at some of these. How can we create a diversified portfolio. Typically, the recommendation is to own a collection of equity mutual funds or individually managed stock accounts. So first, let's look at what the typical investor does under the advice of a broker or on his own. Based again on the Dalbar study we discussed earlier today, which measured actual investor behavior. So you can take that to the bank. If we look at the same time frame from 93 to 2012, we see drastically different results from the published returns of mutual funds as a whole. The annualized rate of return for investors investing in equity-based mutual funds in that period was a disappointing 4.25%. What happened? Was the market that bad over the time period, or was something else going on? Well, get these up for you. One answer is found, and once again, in the Dalbar study. The average investor's holding period was only slightly more than 3 years for the 20-year period that covered by the study. So that means that they were probably, getting out at the worst possible time in the market and getting in at the worst possible time. So rather than buying a fund and holding it for the long term, the average investor appears to be chasing performance, exchanging one mutual fund for another based on some sort of ranking system or the advice of a financial broker or something. These funds which have had superior performance over a period of time are likely to be heavily invested in one or two market segments and not greatly diversified. When these market segments go sour, investors tend to sell the funds and buy other better current performers. We call this chasing the market. Other factors contributing to the low annualized return for investors over the 20-year period are stock picking and attempts to time the market, which is also evidence of chasing the market. Okay, so how can we improve this? Had an investor stayed fully invested in just the S&P, for example, over the 43-year period, rather than chasing the market, annualized gross returns would have been just under 10% per year, nearly 3 times the mutual fund return, with about 10% less volatility, a less bumpy ride than the average investor. This is demonstrated by Portfolio 1. So just by owning a broad market index of just U.S. large stocks in the S&P, no timing, no playing with it, no nothing, the return could potentially improve dramatically with less volatility. We'll show you how. Next, we're going to include some fixed income securities in the portfolio, sort of as a volatility dampener, as I say. The market factor we discussed earlier makes that an important decision facing an investor is the percentage of how much the portfolio invested in fixed income versus equities. This is what we help people with as a coach. We help you get closer to knowing what you want, and we help advise you and provide and coach you to do what's consistent with you. So in this example, we're going to use 40% with 20% in 5-year government bond portfolios and 20% in 1-year fixed income. Placing 40% of the portfolio in these fixed assets dramatically reduce the volatility from a standard deviation, which is your risk or swing number, of 17.5 down to just a little under 11. That's nearly 40% reduction. 40% reduction. Even so, it had very little impact on portfolio returns. Next, we're going to alter the portfolio by adding international stocks. Instead of having 60% in U.S. large company cap stocks, we're going to move 30% into European, Australian, and Far East funds, which is the EAFE index. Stocks in this index represent the largest stocks on a global basis that's outside the U.S. And the impact of this global diversification is to add some potential return while taking on minimal additional volatility. A pretty good trade-off. What's more, it creates the possibility of benefiting from geopolitical diversification. Now let's alter the portfolio to address the size factor. We're dealing with really showing you how the 3 factors are, how they dictate portfolio design. Now let's alter the size factor by using small cap and international small cap. Based on historical data reflected in Portfolio 4, returns showed the potential to increase dramatically in exchange for a nominal increase in volatility. And lastly, let's just adjust the portfolio to include the value factor, and by adding 7.5% U.S. small cap value and the same percentage in U.S. large cap value, and adjusting them across other equity categories, as you can see is Portfolio 5. Shows an annualized rate of return of 10.76% with a swing of just well under 12. So how does that compare to the average mutual fund investor's return? How does it compare to the S&P in Portfolio 1? So without using any investing methods, stock picking, market timing, or using a manager's track record, you have seen right here how we were able to create a portfolio with better historical returns and reduced risk. Small cap stocks are generally subject to a higher degree of market risk. That's one of the three-factor model than a large cap stock or more established companies. So the illiquidity of the small cap market may adversely affect the value of an investment, so that shares, when redeemed, may be worth more or less than their original cost. So we're winding up here. You could download the 20 must answer questions from the Maths and Money site. We also can provide them for you if you request it. And we end every coaching session with this, because you need to answer each question yes or no, and you must be 100% to answer, to qualify yes as a yes. You have to be honest. You should have mostly no's if you're really being honest, unless you're an investment professional and an enlightened one. So number one, I'll go through these very quickly. Have you discovered your true purpose for money? That which is more important than money itself? Yes or no? It's not enough to know that your money is not the most important thing in life. To actually get a yes to this question, you have to be able to know what is most important to you. That which is more important than just the actual money. And that which is more important than everything else to you in your life. Number two, are you invested in the market? Meaning, do you have equity stocks, or do you at least have equity-based mutual funds? Most people easily get a yes to this question, because most people today have some money in the market, whether it's in 401k, pension, or any personal investments. Question three, do you know how markets work? I talk to investors all the time, and they have money in the market, but then when it comes to understanding the underlying dynamics of how markets work, they really don't know. It can be very disconcerting to have a portion of your wealth invested in a way that you simply do not understand. Have you defined your investment philosophy? We all know that whether it's religion or education, science or history, your philosophy is imperative in helping make decisions that are right for you. So as we've discussed, there are two basic philosophies. One that's markets work, and one that markets do not work. A free market, like Adam Smith said, gets the best possible price and plans, all the plans and knowable information, and prices it into the pricing system today. That is the basic philosophy and foundation for the free enterprise system that's alive in America today. Other investment philosophies that markets fail, we reject this philosophy completely. Once you're able to identify your philosophy, you'll be able to design an investment strategy with your coach supportive of your philosophy. So many people try to strategize before they even understand the two fundamental investing philosophies and which side they're on, because you can't be on both. So number four, have you defined your investment philosophy? Question number five, have you identified your personal risk tolerance? Have you thought about it and cognitively, consciously made a decision of how much and what type of risk you're comfortable with in your portfolio? Or have you had more of a smorgasbord approach where one year this investment looks good, another year that one looked good, and over the years you just kind of haphazardly built a portfolio with risks you don't even understand? Number six, do you know how to measure diversification in your portfolio? Do you know how well or how poorly you're diversified? Do you consistently and predictably achieve market returns? Answering yes to this question requires some historical knowledge of the market and actual market rates of return. So these benchmarks you want to look at as you build your portfolio, because most people don't know what markets have done historically, and they have no idea whether they have achieved market-like returns or underperformed. Statistically, the vast majority of investors underperform market rates of return. Have you measured the total amount of commissions or costs in your portfolio? You know, earlier we talked how many people are unaware of the costs that affect their investments. You've begun to learn today, but you can find out exactly in your case with our portfolio MRI as to what is your current number. Do you know where you fall on the Markowitz efficient frontier? You know, he won the Nobel Prize, and we determined you can identify by looking at historic rates of return and asset correlation. You know, and to pursue successful investing, it's critical to know where you fall on that frontier so that you can measure your rate of return against the most important thing, the risks you're taking. When it comes to building your investment portfolio, do you know exactly what you're doing and why? Are you working with a financial planner or are you working with a coach? A financial coach helps you focus on answering these 20 must-answer questions that we're talking about today. After actually a couple of 2-3 months even with coaching classes and private meetings in the beginning, you will be able to answer yes to every single one of those questions. You will have achieved a breakthrough financially that will change your life for the better financially. Do you have a customized lifelong game plan to guide you? You know, we're talking about ways of looking at everything that's value to you, not just money, your life goals, your assets, whatever it might be. And actually planning out what you want to do with your life and your money so that when it comes to the end, like Ebenezer Scrooge looking at his gravestone, you can say you lived a life without regret. Do you have an investment policy statement? Do you even know what an investment policy statement is? You should have one. Have you devised a clear-cut method for measuring the success or failure of your portfolio? Do you fully understand the implications of diversification in your portfolio and how to build it in? Do you have a system to measure volatility? Are you aware of the costs associated with purchasing commission-based products and why that is not the only game in town, but it'll never go away because they have the bigger lobby than the no-load or fee-based world? 18. Do you know the 3 warning signs that you may be speculating or gambling with your money versus prudently investing it? It's very difficult for most people to know if they're investing prudently rather than speculating because they have no way of distinguishing between the two, and we're able to help bring that clarity to you in our coaching sessions. And number 19, can you identify cultural messages and all these personal mindsets about money that destroy your peace of mind, like watching CNBC, hearing scare tactics? Remember, they're just trying to get people to tune in for advertising. They know that fear or greed sells, and they exploit that to the umph. And I consider it almost financial pornography, as Mark says. Number 20, are you ready to shift your personal experience of money? Thinking, what's the market going to do? What do you think? What stocks do you like? What is this newest mousetrap? Are you willing to go from the scarcity mode where you can live your life to an abundance mode rather than obsessing about your assets? I used to be the ultimate quintessential obsessor, and I am not as a person or as an advisor any longer. I can personally testify that this process I went through first before I showed any clients, and that it changed my life, and it changed my practice, and it's changing everybody that I know's life because it involves continuous coaching and education, something that you rarely can find out there. So the opportunity is to learn more about what this means for you, and that would be by contacting us at 440-519-0300 and ask to speak to Paula, Pam, Dan, or Jeff, myself. And if you would like to get a portfolio MRI and an overlap report to show you how you are under diversified or whatever the case may be, we will be able to quantify your risk, we'll be able to plot you on the horizon, and we'll be able to show you how we can improve that in a low-cost, efficient way. So this is Jeff Serino, founder of Alpha Planning, and I hope you really enjoyed this, and I do encourage you to go back as many times as you need to, because I'm going to tell you this is the cornerstone of the whole Mattson modern portfolio theory, and we're touching on a lot of things that it's based on, such as the 3-factor model, efficient market horizon, and other modern portfolio theory. So I know this was a little bit long, but I hope that it was chock full of information. So we have all the end notes and everything on here. If you ever want to see the sources of any of the studies or information that we have. Everything is completely approved and is provable here. So what I've said to you today, you can really take that to the bank. Thank you very much, and I wish you very, very much success in your financial dreams.